for my personal opinion, the reason why I avoid distress is because of the high number of variables that are involved and the number of things that can go wrong. Like obviously, if I buy a property and I go in with the proper team, that still doesn't address the fact that I could break into the walls, or we could go to the HVAC, or we could go under the roof and find some insane problem that is going to cost us a ton of money. And I know just from my minor experience dealing with smaller properties, I couldn't imagine how much that would add up on a big apartment building. If I've already seen what's happened on the properties I have now. Now, of course, that could be reduced through proper due diligence, which I would have to do for distressed. But I still think that there's that added level of or an additional layer of things that could go wrong for distressed properties. And I just personally don't have the personality that'd be able to handle that or really like that. Whereas from my understanding for value add, yes, you're still renovating things, but these larger items are already completed, or at least not in complete disarray. And so another thing too, and again, I'm not necessarily dealing with this, but I guess it also depends on why if the reason this distress is because of the tenant situation. Are there actually other tenants that you could find, or is that just what the area actually is? Which I guess you could technically do up front. But this, for me personally, the added layer of risk that comes from the number of variables and having to address these major issues, I'm just not comfortable with that.
I'm glad you're not comfortable, because then that opens up opportunities for other people to do it and take on that higher level of risk to receive the higher level of returns.
There is one more thing too. Again, from my understanding of the distressed model, is that I would be not afraid, obviously, but I'd be curious to see how much harder it is to attract investors to those kind of deals, because of course you're not promising them, but offering them the potential for a large return at sale. But I mean, from their perspective, there's definitely a lot more risk because they're not really getting a return along the way, because there is no money coming in from the property at all. They have to find people that are comfortable not making money at first. And I would imagine that the type of person that would do that would have more experience as a passive investor. Maybe they've done a few maybe they invest in a few turnkey or value add apartments and are willing to take that extra layer, that extra level of risk on the turnkey, on the distress model. So I mean, I'd be curious to see what your thoughts are on that, but I would just imagine it'd be harder to attract investors for a distressed deal.
I imagine it would be too. Stepping outside of our role play back and forth, I've never done a distressed deal, so I don't know. I haven't spoken to investors about distressed deals. I imagine with a distressed deal, you will not only get investors who are more experienced in investing in deals, but also investors who have a higher risk threshold and are in larger amounts of capital to invest, because if you invest in a distressed deal, you've got to really be okay with losing your money. I mean, I guess that's with any investment, but there's a lot more risk involved with the distressed deal.